Well, limitations of company guidance come about for a number of reasons, right? So one reason is the need for management and boards to follow due process. Okay, so that can work for us in terms of helping us identify positive opportunities, and it can also work for us in helping to identify negative opportunities. So what's an example of positive space? Particularly companies that are thinking about rolling out more stores, rolling out new products, they need to go through a process where they justify that to their board. They might be trialling some stores, trialling some concepts, and then they can put a report together, then they can go to the board thinks about whether they're going to raise capital, and once the board's made a final decision, then they can go to the market. So, but what we do know is we know that if a board finds that there's an opportunity right in its core area where it can get really high return on equity, it's almost certainly going to be doing it, because apart from making that very seldom seen opportunity as a decision, the board's mostly bogged down in day-to-day minutiae of running the company. So I'll give you an example of that. Arden Leisure. Arden Leisure's got this main event business in the United States, family entertainment centres where they combine bowling and rock climbing and laser tag and mini golf and so forth. And the return on those centres is circa 30% on capital. It bought this business when there were only 5 centres in Texas, and it was rolling out 1 or 2 a year. And of course it looked like it was massively going to roll it out. And the analysts, however, when they went to ask the company, you're going to roll out more, the company would say, well, we have to see how we go. The board hasn't made any decision on that yet. And of course, as it turned out, they just hit the accelerator, and they're now, looking at a target of 200 stores ultimately in the United States, after for a couple of years telling us it's only going to be 1 to 2. So that's a positive example. A negative example of following due process we saw in the case of Myer, when Myer was doing a strategic review. And you recall that it was going through some problems. The managing director had left, the CFO had left, and the chairman had to deliver the announcement to the market. And he was asked about would they be raising more debt, would they be doing an equity issue, and it wasn't appropriate for him to say it because the strategic review hadn't completed. He hadn't taken it to the board, and of course, so he did his best to avoid answering questions along those lines, and ultimately said, well, we're still doing the strategic review, we'll see how we go. But that is looking through the limitation of what he could say. Now that's one aspect of limitations of company guidance. The other aspect of limitations of company guidance is around really what they're not telling you. So it's not because they can't tell you, it's because they don't want to tell you, right? And so, and you've got to look through that. It was really brought home to me by Roger Corbett, who was the ex-managing director of Woolworths quite a number of years ago, in a conversation we had when he was talking about walking around a store and looking at the fruit and vegetable section, which was pretty empty in the Woolworths, and he looked across the arcade and he saw there was quite a few people in the greengrocers across the arcade, and he said to the manager of the store, what are the customers telling you? And the manager said, well, they're not telling me anything, Roger. And Roger said, yes they are, they're screaming at you, right? So often the management and board of a company are really screaming at you without saying anything at all. So I've got quite a lot of examples of that, from the situation where they actually pull things out of their presentations that they used to put in for years and years. Sky TV in New Zealand was a great example of this, where they pulled out the composition of their subscriber numbers, a slide that had probably been in that presentation every half of 15 years, but they didn't want to talk about that because the subscriber numbers were starting to fall. We see that over and over again in companies' conversations. I had recently a company I was talking to was asking them about the cash, and he gave a very helpful answer, but he didn't actually tell me what his cash position was. And I went back and I asked that again. And when people don't want to lie, they try to be helpful, but they try to avoid answering the question. So we see that time and time again. Another thing they do is they leave the company. And so again, when you see directors and management leaving a company, even though they're saying things are okay, That's a very strong signal. So quite an extreme example of that, again, Myer that we talked about, where independent directors were leaving and the management was leaving. But even Fairfax many years ago, Fairfax people, managing directors, independent directors of this rather prestigious company were leaving. Managing directors often leave when the best days of the company are behind them as well. And they're not going to say, oh, the best days of the company are behind us, particularly when they have large shareholdings. So another classic example is when you have a managing director who's come onto a company and has only been there for 18 months or so, has very big plans for the future. Maybe the analysts are expecting a 3-year, 4-year plan of change and everything, and then they leave abruptly for one reason or another. That's another huge signal. So all these signals are limitations of companies' management. More often to the negative than the positive, but it's that reading between the lines and truly trying to understand that these are real people having to follow real processes. They just can't do what the hell they want, and from a psychological and behavioural point of view, while they don't want to lie, they want to avoid bad situations, whether that means they leave the company or they sort of avoid talking about things that might otherwise be important to investors.